There's a hidden signal in the market that has triggered every major financial crash of the 21st century. And right now, in 2024, that signal is flashing redder than ever before, stage by stage, decision by decision, almost like Wall Street is reading from the same script that led to ruin every single time before. In 2000, the Nasdaq was a rocket ship. Dot-com millionaires were minted overnight. Investors believed in a new economy that would never go down. They borrowed record amounts of money to chase the mania. Within 24 months, the index crashed 78%, wiping out trillions in wealth. In 2008, the housing market was a sure bet. Subprime was contained. Banks had sophisticated risk models. Investors, hedge funds, and even the banks themselves leveraged up to historic levels, betting on an unstoppable rise. Within a year, the global financial system imploded. Lehman Brothers vanished, and the world plunged into the Great Recession. In 2021, tech stocks, crypto, and SPACs were the future. Money was free. The Fed had our back. Speculators took on more debt than at any point in human history to buy assets at nosebleed valuations. It ended in a brutal bear market that erased years of gains. 3 times. 3 speculative manias. 3 devastating crashes, all triggered by the exact same mechanism. And here's what should terrify you. The market has already completed the full cycle of leverage. We're not approaching the danger. We're living on top of it. This is the story of how debt kills markets, why investors always think this time is different, and why the math says the unwind is next. And it's poised to be more violent than anyone wants to admit. Margin debt has surged to levels that rival, and in some cases exceed, the peaks of the most infamous bubbles in modern history. This isn't just a niche indicator watched by a few Wall Street quants. It's a measure of the entire market's structural integrity. It represents the total amount of money investors have borrowed against their portfolios to buy even more stocks. Think of it as pouring gasoline on a fire. When the market is rising, this leverage acts as a powerful accelerant, multiplying gains and creating an illusion of genius. But when the market turns, that same leverage becomes a deadly amplifier for losses, transforming a simple correction into a catastrophic, self-reinforcing collapse. This debt is the financial system's gunpowder, and the keg is filled to the brim, waiting for a single spark to set it off. History provides a chillingly consistent roadmap. Every major market correction of the past quarter century was preceded by a dramatic spike in margin debt. Before the dot-com bust in 2000, margin debt skyrocketed, peaking just as the bubble was about to burst. Before the 2008 global financial crisis, leverage once again climbed to unprecedented heights, fueling the credit and housing mania that brought the world economy to its knees. And in late 2021, as meme stocks and speculative tech reached their zenith, margin debt hit an all-time record just before the market rolled over into a punishing bear market. In each instance, the buildup of leverage was celebrated as a sign of investor confidence. In reality, it was the final, desperate phase of a speculative fever dream, setting the stage for the inevitable nightmare to follow. Today, the situation is arguably even more precarious. While the absolute dollar amount of margin debt may fluctuate, its level relative to the size of the economy remains alarmingly high, deeply embedded in the market's DNA. We are living in the shadow of the 2021 peak, a mountain of leverage that has not been meaningfully unwound. The debt that fueled the everything bubble hasn't disappeared. It has simply been papered over, waiting for the next shock. The amount of leverage currently propping up asset prices makes the peaks of 2000 and 2008 look like foothills before the Everest of systemic risk we face today. This isn't just a repeat of history, it's history on steroids, a setup for a deleveraging event that could dwarf what we've seen before. The fuel for this mountain of debt is a powerful psychological cocktail of greed and delusion. It's the fear of missing out, the FOMO that grips investors as they watch their neighbors get rich on speculative bets. It's the belief in a new paradigm, the seductive idea that old rules of valuation no longer apply. And it's the illusion of endless liquidity, the conviction that central banks will always step in to backstop losses and keep the party going. This collective psychosis creates speculative bubbles, where asset prices detach from their underlying fundamentals and become a pure function of momentum and belief. Investors stop asking, "What is this worth?" and start asking, "Will it go higher tomorrow?" In that environment, borrowing money to chase yesterday's winners feels not just smart, but necessary. For more than a decade, this speculative impulse was actively encouraged by the world's central banks. An era of ultra-low, near-zero interest rates made borrowing money almost free. Quantitative easing programs flooded the financial system with trillions of dollars, creating an ocean of liquidity that had to find a home. This easy money policy was the explicit goal: to push investors out on the risk curve and encourage borrowing and spending. It worked, but it created a monster. A whole generation of investors and traders learned to operate in a world without consequences, where leverage was always rewarded and risk was always bailed out. They built their strategies, their portfolios, and their entire worldview on a foundation of cheap debt, a foundation that is now cracking. Now, the macroeconomic landscape has been turned upside down. Interest rates have risen at the fastest pace in 40 years, turning cheap debt into a costly liability. Liquidity is being drained from the system through quantitative tightening, as central banks reverse their money printing operations. The tide of easy money that lifted all boats is now rushing out, and we are about to see who has been swimming naked. This shift creates the perfect storm for a catastrophic deleveraging. The very conditions that encourage the massive buildup of margin debt have now inverted, transforming a tailwind into a vicious headwind. The party is over, the lights are on, and the bill for a decade of excess is coming due. When the unwind begins, it will not be orderly. It will be triggered by margin calls. A margin call is the moment the music stops. When the value of an investor's portfolio drops below a certain threshold, their broker demands they deposit more cash or sell assets to cover their losses. The problem is, in a falling market, most leveraged investors don't have the cash. They are forced to sell. But their forced selling pushes prices down even further, which triggers more margin calls for other investors who are then also forced to sell. This creates a terrifying feedback loop, a cascading waterfall of liquidations where selling begets more selling. It's a chain reaction that feeds on itself, accelerating declines and turning a manageable downturn into a full-blown market panic. This vulnerability isn't confined to a few reckless day traders. Everyone is exposed. Retail traders, armed with commission-free trading apps and easy access to leverage, are sitting on a powder keg. But so are the big players. Sophisticated hedge funds, employing complex strategies built on layers of leverage, are just as susceptible. A sudden market shock could force them to unwind massive positions, sending shockwaves across the entire financial system. From the smallest Robinhood account to the largest multi-billion-dollar fund, the system is saturated with borrowed money. When the deleveraging cascade starts, no one will be safe from the domino effect. Even those who believe they are playing it safe are unknowingly exposed. The hidden risk lies within the financial plumbing of supposedly safe investment vehicles like ETFs and passive index funds. Many of these funds use derivatives and other forms of implicit leverage to track their benchmarks. A crisis in the margin lending market could create liquidity problems in the ETF market, causing their prices to detach from their net asset value and amplifying systemic stress. Your diversified and a passive portfolio may have far more leverage baked into its DNA than you could ever imagine. The warning signs are already here if you know where to look. We are already seeing sudden spikes in volatility, or flash crashes, where liquidity evaporates in an instant. We are seeing cracks appear in the credit markets, where the cost of borrowing is rising for even the most stable companies. These are the tremors before the earthquake. The unwind may not be a single event, but a series of escalating shocks. The process has likely already begun, quietly, beneath the surface. A violent unwind in the stock market will not stay contained. Financial markets are more interconnected than ever before. A margin call-driven crash in equities would trigger a flight to safety, but it would also force leveraged players to sell whatever they can, wherever they can. This means forced liquidations could easily spill over into the bond market, the real estate market, and especially the highly leveraged crypto market. As investors scramble for cash to meet margin calls, they will sell their good assets along with their bad ones. This contagion effect can turn a stock market problem into a systemic crisis, threatening the stability of the entire global economy. This time, the selling pressure will be amplified by forces that didn't exist in previous crashes. A significant portion of today's trading volume is driven by AI and quantitative algorithms. These systems are programmed to react to momentum and volatility. During a forced liquidation event, these algorithms will interpret the initial selling as a trend, and they will pile on, adding their own immense selling pressure to the cascade. The final warning is this: leverage is a promise that is always broken. The buildup is slow, seductive, and feels like free money.